Well, I hope everyone enjoyed the day's presentations. I've really heard some very positive feedback, both in very lively discussions and Q&A and also eavesdropping on a few conversations. But anyway, we're now on the home stretch and with our final panel before the evening reception. So I won't make any comparisons about any of the presentations, but only share my personal view that I've been looking forward to our second plenary panel all day. Our panelists' research interests comprise economic inclusion, wealth inequality, taxation, behavioral finance, and legacy policies impacting wealth creation, among others. Areas of great interest to me, in particular the last. So our moderator is Ida Rademacher, Executive Director of the Aspen Financial Security Program, which is addressing key financial challenges facing U.S. households and helping to shape related market and policy innovations. And so I can't think of anybody better to lead the discussion. Please join me in welcoming Ida and our panel.
Thanks, Mike. Good afternoon, everyone. It's great to be here. And I was unable to be here in the morning, but I had an actual working Wi-Fi connection on my Southwest flight from San Antonio, so I've been following Twitter. And I want to say thank you to all the tweeters in the room for keeping me like I feel like I've been in the room this morning, so I appreciate that. And thanks also to the entire Federal Reserve System for, as always, the thoughtful curation of topics and speakers. I'm looking forward to this conversation, much like Mike was, as the highlight of the pieces of the pathway to the middle class that I'm most passionate about and thought I knew a lot about until I started reading all the papers of my speakers today. So we're going to have a great conversation. The topic at hand is taking stock of the financial security and wealth in America today as it relates to the size and composition of the middle class. And an idea that I'd like to put out there, that just like there are social determinants of health, there's social determinants of wealth. And really, we're going to be talking about that from a lot of different angles on this panel today. And I'm just going to say a couple of additional table-setting observations that I have, none of which are new, but are kind of grounding observations each time I think about the connection between wealth and the middle class. You know, and one of those is, now I was amazed to see this, a decade-old piece of research from the Pew Economic Mobility Project that really makes the case, I think, profoundly that we often conflate middle income and middle class, and there really isn't a way to see that as not being true more powerfully than the findings from this research. So the research looked at solidly middle income African American and white households, and then looked at their kids a generation later. And what they saw was that almost half of the kids from those black households, 45%, had moved down to the bottom of the income brackets, and 16% of kids from white households had. So there's clearly something besides income that makes the middle class sticky. And one of the things that really comes up over and over is that stickiness is wealth, that financial security, that resilience that comes from home ownership, higher education, retirement accounts, but increasingly this social determinant of wealth, this idea of access to credit, and we're going to hit that in many different dimensions today, which is going to be great. And then the other thing that came to mind today was that, and I don't know how many of you all know this, but it's a complete factoid that I'll throw in, and then we're going to throw in a few more to get us going today. That there's an opposite of well, which is when you're not well, you're ill. And in the world of wealth, there's an actual word for the opposite of wealth, which is ILF. And it was coined by John Ruskin. It's a great word. It sounds like you have a lisp. But it was coined by John Ruskin in the Victorian era, who was a leading philanthropist, critiquing that era of inequality and looking at the problems of ILF. And I think that a lot of what we're going to talk about today is, if we're looking at the fragile and fragmented state of the middle class, is we're going to be looking at ILF in some ways. And one of my mentors, Herman Daly, who I studied with, kind of recoined it in a modern era in economics. So we're going to go forward with that, with three amazing and incredibly intimidating to me researchers. And I'm just going to go in order and introduce you, and then we're going to play a little game. And then we're going to get into this stuff. But I figured it's late enough in the day, we have to get a little punchy. Or it's late enough in my day that I have to get a little punchy. So we'll keep this real. So just to my left is Mirza Baradaran. Hello.
Hi.
Associate Dean at the School of Law at the University of Georgia. In addition to that full teaching schedule, she's authored the two books that I love, How the Other Half Banks and The Color of Money, Black Banks and the Racial Wealth Gap, both worth a great read, and deep, deep work on the racial wealth gap from the perspective of somebody in a law school. So we're looking forward to hearing from you. And then next we're going to hear from Cindy Sue. Hi, Cindy. Assistant Professor of Finance at the Ross School of Business in the University of Michigan. So much really interesting research on access to credit, payday loans, and again, in a business school doing household finance, a growing area of work, but you're still probably one of a couple at your own business school doing that. So excited to hear from you. And then finally, we'll hear from Adam Looney. Hi, Adam.
Hi.
Currently Senior Fellow in the Economic Studies Group at Brookings, has also had a few other posts in recent times. Senior economist at the White House Council of Economic Advisors, in the last administration, Deputy Assistant Secretary of Treasury on tax policy issues in the past, so welcome. Specifically today, talking about some of the causes and consequences of student loan distress, which again, higher education was one of those access points, but not in the case. So. Oh, and I tried to mute my phone. That's my phone, people, so it's okay. Just put it on the side. And it's also my own stop award, so you're saying stop. I was going to play a game with you all, but I think we should just go ahead and turn it over to you to do your presentations, and we'll play the game at the end.
Okay.
Okay.
Go up to the
Go
podium.
ahead up and go up. Thank you very much.
Okay, so I'd like to talk today about the racial wealth gap, and I want to show how the role of credit policies, economic theories, and banks act in creating and perpetuating it, and explore why it hasn't abated over time. So this is the racial wealth gap, and we talked in the last panel, the one I went to at least, on student debt. This is a gap that is wide and growing and that doesn't abate with increased education. So education ends up not being an answer. I mean, there is a gain in wealth, but the gap remains. And then this is the other stat that I highlight in my book, in that post-Civil War, the black population had 0.5% of the wealth. This is in 1865. Today, that portion hasn't budged all that much. It's about 1 to 2%. So to say that our public policy efforts to eradicate the wealth gap have been a total failure is an understatement. I want to talk about a couple of historical moments. I'm going to skip quite a bit today because I only have 15 minutes, but if you want to know the whole story, you can read the book. But in each historical moment in the US, when wealth was created, whether it was through the Homestead Acts, through the FHA mortgage credit, that's the one I'm going to talk about, Black communities were shut out of land and wealth accumulation. Moreover, at certain pivot points in history, specifically during Reconstruction and the Civil Rights era, and I'll talk about the latter, where Black communities were demanding state intervention and capital to remedy historic injustice, the white power structure offered segregated self-help institutions, Black capitalism, Black banking, that promised that the market would fix the problems that law, policy, backed by state violence created. So the first of those, and I'm going to skip, sorry, this is all very riveting and you really should read the book. In the New Deal, Roosevelt restructures banking and credit markets through heavy state intervention. Between 1933 and 1970, hundreds and thousands of small community banks, credit unions, thrifts, ILCs are formed, and they're safe, stable, profitable. The reason these banks are thriving is because the New Deal essentially takes the risk out of banking, as you all probably know. Deposits are insured by the FDIC, loans are subsidized by the FHA, the GI Bill, the Farm Loan Programs, Fannie Mae. All of this built the American middle class, and created intergenerational wealth through home ownership and lower cost higher education, which again we're talking about today. In return, banks are heavily regulated with interest rate caps, geographic restrictions, activity restrictions, capital controls. For a while, the only way banks could compete against each other was by offering toasters and umbrellas, which is the reason they did that. So the mythical George Bailey Bank that we celebrate every year was not actually taking money from the nice residents of Bedford Falls and simply investing them in their homes, although they were doing that. But all the home mortgages that Thrifts lent were backed by FHA mortgage credit, just like Potter's Bank would have been. Hopefully you all watched that movie and get the reference. My students no longer do. So local and small banks were made possible through large federal credit programs. And these are the programs that built wealth. And by the way, it was the Southern Democrats in the Senate that pushed through FDR's New Deal, the same Southern bloc that made sure that no anti-lynching bill reached the floor despite 240 attempts. So the New Deal built sort of a white suburb of homeowners and a segregated black ghetto through redlining. And I'm going to use the word ghetto because it's more accurate, and that's the term that was used by the activists at the time. A black community assumes that geographic segregation was voluntary. It was not. So HOLC appraisers use census data and elaborate questionnaires to predict the likelihood of property appreciation in neighborhoods across the country. These maps had 4 colors based on different categories of perceived risk: A, green, blue, C, yellow, and then red meant high risk. And in making judgments about the home's potential to appreciate, these HOLC map makers, and this is one specific thing. So if you go to, there's this mapping inequality domain that has all of these original FHA maps. This is the one I like to pull up. You can't see it, but you should go check it out. This is Atlanta. That red area right there is where Morehouse and Spelman is. Anyone from Atlanta? Morehouse and Spelman used to be, so this is 1934, was and as it says on this form, the best Negro area in the country. They were the historically black colleges, all the homes were owned. It was a very nice area where businessmen, it was mostly men at the time, populated. That area was labeled red, okay? High risk, and the top level, the top of the form says percentage Negro, percentage infiltration of, so what is the threat that blacks were close to that area, and then foreign-born, percentage of foreign-born, percentage infiltration of foreign-born. Okay, so race was the number 1 indicator of risk. And so what these maps do is that they create risk-based maps that are based on race. And they sort of cordon off the risk into those red areas, and the yellow and the greens are able to get these mortgage loans. So it's geographic risk management. And as the white American suburbs sort of grew by leaps and bounds, this is, again, the era when America apparently was great, the segregated black economy became locked in a state of perpetual depression due to this exploitation and exclusion. So on top of the FHA mortgage loans, there was another dual market in consumer credit that was also created during this time. The FHA Part 2 also had a consumer loan guarantee that was short-lived but was around long enough to create a secondary market in consumer credit. So in the suburbs, department stores began offering credit cards with a revolving credit line. This type of credit was flexible and it was low interest. In the black ghetto, there was only installment credit. So consumers with little wealth bought necessities, including medical care, with installment credit. And the way these contracts were structured was that the goods were purchased bundled together. And each payment, and these were all done by contract, each payment went to pay off a slice of the total interest and principal. So if you missed one payment, the borrower was deemed to be in default of the entire bundle of goods. And this was enforced by the courts. Default involved, of course, repo men, criminal penalties, and sometimes threats of bodily injury. It was much different than revolving credit in the suburbs. Because of the high cost of credit, residents in the black ghettos were paying 5 times more for lower quality goods and services. Add to that the hassle of lending and the shame and embarrassment of having repo men come through from one missed payment. So the seeds of the civil rights movement were the Montgomery bus boycott is the first time the national government starts to pay attention. But before the Montgomery bus boycott, there was a Harlem boycott of these installment lenders and a Chicago boycott. So the seeds of that were started there, and the courts sanctioned these boycotts. So in 1935, there was a court case saying, you know, this lender goes and says, why, you know, people, it's illegal to boycott excuse me, and the court says, no, this is a constitutional right to boycott. And so that sort of opens the floodgates and lots of boycotts start. And of course, the Montgomery bus boycott was the one that got national attention. But there was a lot of attention being paid by activists and reformers in New York and Chicago and other places on this dual credit market. So the early civil rights leaders, Malcolm X starts his movement talks about, look, a revolution is based on land. We need sovereignty, autonomy in our community. Why should white people be running the banks of our community? Very much focused on this inequality. Martin Luther King, I'm not going to play this. If you look at his I Have a Dream speech from the lens of a banker, which you should, he is very much discussing the sort of threat that the threat of inequality through the lens of economic injustice and asking for redress specifically in this speech. But in this in his first sort of foray into civil rights in 1954, he does an ebony column and in which he says these are the 10-point plan for our movement, and number 1, 2, and 3 were to create credit unions and banks and to have economic sort of cohesion, and number 6 was voting. So both leaders that are sometimes contrasted against each other understood that this economic injustice was a pivotal and central part of the program. And then, of course, in his last speech before he was killed, he talks about a bank-in movement. He's in Memphis. He says, take your money out of the banks and put it in. So very much boycott and protest. Along with that, there was the Poor People's Movement, which was, again, about economic injustice. So the idea was, look, yes, the whites-only signs were gone. Jim Crow laws were done. But joblessness, dilapidated housing, and intractable poverty were not. The Federal Reserve actually found that at the time in 1967, that blacks had 1/5 of the wealth of white families. Half of black children grew up in deep poverty compared to 9% of white children. Those stats, compared to measurements today, are a little bit better than what some of the measurements today reveal. But everything changed, of course, from 1965 to 1968. Black protest turned into a resistance movement, and the nation's mood shifted. By 1966, Roger Wilkins of the NAACP says it would have been hard to pass the Emancipation Proclamation in the atmosphere prevailing right now in 1966. The Kerner Commission, 1968, comes out and says they study the protests and the riots, and they say what white America has never fully understood, but what the Negro can never forget is that white society is deeply implicated in the ghetto. White institutions created it, white institutions maintain it, and white society condones it. So there was also 2 large hearings conducted by the Senate Banking Commission, which don't get a lot of committee in the Senate, which don't get a lot of attention, but they were led by Senator William Proxmire, who's this great reformer, and there were studies presented by the FTC, and the committee is looking at the protests and riots dealing with the credit. And they find 3 things. One is that the rioters in these sort of segregated ghettos are targeting lenders. And they're saying things like burn the books. Okay, so the lenders were the symbols of white oppression in these places. 2, that the rioters are leaving the black lenders and black businesses, or as Senator Jacob Javits calls them, the soul brother establishments, alone. And 3, and this is one that is supported by both studies, but ignored by every other policymaker afterwards, but something I want to clarify for this room, is that these lenders are not making a profit. They just operate in a different lending market. So 94% of the difference in cost between installment credit and revolving credit has to do with increased risk and default. It just costs more to lend into those ghetto because of those maps that were created, because there's low wealth, there's high debt, and you're not able to take advantage of the secondary markets like those revolving credit markets can. So it's just higher risk. Yet, Proxmire is a true Jeffersonian and really believes in credit unions and small banks, and so pushes that as part of his plan. And then there's the 1968 election, and of course, Romney is a Republican, one of the Republican contenders before he bows out. He describes, this is George Romney, describes the white suburb as a high-income white noose around the black inner city. Okay, and then Robert Kennedy was the Democrat and really has plans to fix it. The the winning candidate is Richard Nixon. And the reason I'm stressing this is because I think we talk about Richard Nixon's Southern strategy as, law and order and the way that he won the South based on these dog whistles. But one of the things of his Southern strategy that doesn't get as much discussion that I really cover in my book is this part called black capitalism. And what he does is he takes the community's demands for capital and for sovereignty or otherwise integration. Those were the two plans on the table. So the Kerner Commission, the MLK coalition is pushing integration. Johnson's FHA is pushing integration. And then there's the separatists who are pushing reparations. So there's this core plan that goes to Congress. And so he takes the black power movement's rhetoric. He says, we want more black ownership, black pride, black jobs, black opportunity, and yes, black power. And this is one of his ads in 1968. This is his campaign ad. And I want to focus on the last sentence here. He says, it's time to move past the old civil rights and to bridge the gap between freedom and dignity, between promise and fulfillment. So I've spent months in the Nixon archives, and the great thing about Nixon is that he wrote everything down, or at least they recorded it. And the great thing about the archives is that everyone wants to know about Watergate, and no one looks at the campaign materials. And so the first draft of this speech, in the top, in that line says, it's time to move past. He had just written, forget civil rights. Okay? And there's this memo that he says, I need to communicate that I'm going to lay off the Negro crap. Okay, I'm quoting Richard Nixon. But the message was the same. He couldn't come out and say that, but he could dog whistle. And his dog whistle was, we're going to use black capitalism. And what black capitalism meant was he created the Office of Minority Business Enterprise. Affirmative action was a Nixonian thing. And the idea was that the Treasury would deposit money in black banks. Why is this important? Because this is still the structure that we operate today. So Ronald Reagan talks about minority business being the key to black economic progress. His civil rights plank on his agenda is, his civil rights plank is tax cuts. His civil rights plank is tax cuts. Okay, so that is Ronald Reagan. Clinton, of course, doubles down on this. I'm sorry, was there laughter in the room? That was not mine. Clinton talks about, and I left out Carter, but he also, does this. His thing is the CDFI program, and passes the CDFI bill. He talks about it's not about charity, now it's about investments. His Treasury Secretary, Lawrence Summers, said that minority banks were like niche venture capital firms that deploy their superior knowledge of, I'm quoting, of an emerging market niche to invest and manage risk better than other investors. These banks are market scouts. So the idea is that capitalism is going to fix it. So of course, instead of capital, the ghetto was going to get entrepreneurs. And when they came bearing subprime credit. I'm out of time, and I will discuss more later. But basically, during the financial crisis that happened, the black community lost 53% of their wealth. Okay, these communities don't need entrepreneurship. The other thing that I show is that they have actually had many brilliant and very skillful entrepreneurs, black bankers, that have been trying in these communities to build wealth. The structure doesn't work because of these credit policies that were federal. So I'll leave that. Thank you.
Thank you. So let that sift in for a minute. Cindy, why don't you go ahead and come up, and we'll go ahead and have a mashup of the conversation between all three of us after the presentations.
This is the end.
I thought you were just going to finish her presentation.
Yeah,
You wouldn't mind
I'll
that,
just
right?
go back. Okay, great. Okay, thank you so much to the panel, to Ida, and to the conference organizers for having me. I'm very excited today to share some of my recent research on credit access and payday loan borrowers of low-income borrowers. And I should say all of this work is with my colleague, Sarah Miller, also at University of Michigan at the Business School. So while there are few of us, there are more of us working on these very important topics. So as Marissa was pointing out, the financial crisis really highlighted for us the large disparities in financial outcomes between low-income and high-income neighborhoods. The low-income are more likely to be classified as subprime. They have limited access to formal credit and more likely to engage in high-risk, high-interest subprime credit products like payday loans. When we talk about moving the low-income into the middle class, to keep in mind that basic credit is required for basic housing, for internet cable, so it remains this barrier to economic self-sufficiency. These differences in financial outcomes make it difficult to invest in the future, make it difficult to invest in your children, sort of encouraging and making it impossible to break the cycle of poverty. So what I'm showing you here is a data set that Sarah and I have put together of payday loan borrowing across the US. Okay, so payday loans have been difficult to study due to the limited access of data. So we're very excited to share this with you. What you see here, this is a snapshot in 2016. The darker blue areas indicate more concentrated areas of high payday loan borrowing. So you can see there's high payday loan borrowing in California, Nevada, and then there are other states that are white, that indicate no payday loan borrowing at all. And these are in line with states that have stricter regulations of payday loans versus those that have no payday loan, versus that have high payday loan borrowing and have less restrictive payday loan restrictions. So for those of you who might not be aware, a payday loan is just a single loan. The repayment coincides with your payday, hence the name payday loans. They're often very small, $50 to $100, and the fees are very high, so $10 to $20 per $100 borrowed. Often payday lenders also have automatic rollover options, so you can imagine it very quickly you can incur very high fees and become very difficult to pay back in full. Okay, so it looks like from this map, recent regulations have been successful. There was a crackdown in 2013 at restricting payday loan borrowing in some states. So is the solution just let's restrict payday loan borrowing altogether? Well, when we look at our population of payday loan borrowers, we find that the overwhelming majority is very credit constrained. So what you see here in this plot, this is a histogram of the distribution of the credit utilization or the share of overall credit that payday loan borrowers have taken out on their traditional credit. So what this tells you is over 78% of our payday loan borrowers have taken out more than 80% of their credit. The red bar that you see in this picture, this indicates the sample of payday loan borrowers that have taken out who are over 100% of their credit availability. So we know that they're very credit constrained, so it seems like payday loans are still fulfilling some need of credit. So when we start to look at what drives the payday loan behavior, what we find is that the subprime borrowing is very much driven by location. So what we've done here is if you look at the share of differences, if you look at the differences from a high payday loan area to a low payday loan area, we find a lot of that fraction is driven by where you're located. Okay, so what this plot here shows you, the blue bar indicates the share that's driven by location, and the red bar indicates the share that's driven by your individual circumstance or individual characteristics. And in other words, what we see is if we observe someone who moves from a high payday or low payday loan area to a high payday loan area, we see all of a sudden after their move that they start borrowing like their neighbors. They start taking out more payday loans. We also see the vice versa. So if we see an individual move from a high payday loan area to a low one, they start taking out less payday loans. We see this both across state and within state, so it's not just regulations driving this difference. So over 80% of payday loans taken in storefronts, payday loans taken out online, or subprime installment loans are driven by where you're located. So then the question leads to, well, if we move individuals to a better neighborhood perhaps, can this perhaps improve credit outcomes? And so in another study I have with my colleague Sarah, we used the Moving to Opportunity experiment. Now this was an experiment implemented by HUD in the 1990s where they gave Section 8 vouchers to individuals to move to better neighborhoods. They also gave additional vouchers to a group to move to even better or very low poverty neighborhoods. And we follow the credit outcomes of all of these participants into recent day to see what happened to their credit after they moved to better neighborhoods. And what we find is that a better neighborhood does improve their credit outcomes. The blue bar indicates the group that was moved to the best neighborhoods. The red bar indicates those who are moved to a neighborhood of their choice, but still better neighborhoods. We find that it improves their credit outcomes, their credit scores, their credit limits. It also reduces the debt that they owe, so that's the delinquency bars here, and it reduces the amount of payday loans that they take out. Okay? When we break these outcomes by age, so we follow both the adults who are moved with this program and also the children in the families who are moved to these neighborhoods, we find the better neighborhoods have the most positive impacts for the children in these families. So credit scores in particular, credit limits, your monthly payments, how much credit you have available. These are all better outcomes that we see for children who are moved to these very low poverty neighborhoods into adulthood. What's interesting is that when we follow the adults, we do not find the same improvements in credit scores. What we do find improve among the adults who move to better neighborhoods is that they hold less debt. They hold less amount past due, they hold less in overdue tax loans, and they hold less in court judgments, such as owing child support. Despite all these betterment and repayment behaviors, we do not find that their credit scores improve, suggesting that traditional credit access is still very difficult to achieve, even with better behaviors. So then the question we pose is, what happens if we increase traditional credit access? And this has been something that's proposed by the CFPB, encouraging traditional banks to extend credit to subprime, riskier borrowers. And so what we do is we look across our sample and just look at those who have previously filed for bankruptcy. And then by regulation, 10 years later, had these bankruptcy flag removed. So what you see here on your left in the left plot, the vertical line, that's the moment in time at which these individuals' bankruptcy flags are removed from their credit report, which leads to a sudden jump, which you see in the plot on the right, in credit scores. Okay, so they have a sudden access or sudden shock to their traditional credit access. So what happens when we increase traditional credit access? We find that this reduces payday loan borrowing. Payday loan applications, that's on your left, drop by 67% by the end of 5 years. The amounts that they borrow also drop by $17 per loan by the end of 5 years. And then we also find on the traditional credit market, credit borrowing also improves. So their credit limits, their approved credit limits increase by $1,200 to $1,300 by the end of the first year. That's a 60 to 65% increase. As well as they have improved liquidity across their credit cards, meaning they have more credit available across their credit cards. So that credit constrained picture, they become less credit constrained relative to other borrowers. So the takeaway from the host of these findings so far that we have is that building credit and achieving economic self-sufficiency is vital for economic mobility. When we think about moving these low income into the middle class, this is one aspect that we cannot ignore. However, there still exist high barriers to, as credit behaviors of low-income borrowers do not actually help them build credit. So if you think about a payday loan borrower, let's say, does diligently pay back their payday loan biweekly or month to month, none of this is actually tracked on your traditional credit report. So none of that good repayment behavior actually helps you build credit on the traditional credit market. Moving to a better neighborhood environment does have positive impacts, especially for young children, but we absolutely need to assist adults who are moving those children to those better neighborhoods in order to sustain the economic self-sufficiency to stay there. And then we find that improving traditional credit has positive impacts both on your traditional credit market access and your payday loan behavior. Otherwise, your low-income credit-constrained borrowers only have these high-risk, subprime, high-interest credit products available to them. Thank you very much.
Thanks, Cindy. Adam.
Can you hear me? Yes. Okay. Thank you. Today I'm going to talk about student loans. Does anybody in this room have a student loan, either for themselves or for their spouse or for their children? Seems about right. It should be about 20% of the room if you're representative of the country as a whole. If we were a room full of 30-year-olds or people under 30, it should be about half of us. And if I was giving the commencement speech for the class of 2019, it should be about 70% of you that had some student debt. And that increase in debt has caused many to question what was long a central tenet of the American dream, that education and a college degree was a sure way to achieve a middle-class existence. And so in my talk today, I wanted to examine how we got into a place where we worry about college not being worth it, and how we can restore college as a pathway to the upper middle class. Am I clicking the right buttons here? Okay. So college has long been viewed as a pathway to the middle class, and rightly so. In the labor market, workers with a bachelor's degree earn roughly $500,000 more on average over the course of their careers than do individuals with only high school diplomas. Short of the traditional BA degree, many career-oriented programs offer degrees and certificates that boost their students' job prospects and earnings. And for many of those students, those degrees are a ticket to the middle class. Children from the bottom fifth of the income distribution have a 41% chance of reaching the top 2 quintiles, the top 40% of the income distribution if they earn a college degree, but only a 14% chance if they don't. And the educational workhorses that are responsible for that upward mobility are often middle tier, non-selective, widely available, mostly public institutions. They're not selective or elite schools. And so there are thousands of institutions across the US that regularly have propelled students up the income ladder and lead to good jobs. And so then what happens? Well, we have this student loan crisis that has shaken our faith. Between 2004 and 2018, the outstanding volume of student loan debt jumped from $250 million to $1.5 trillion. Student loans are now the largest source of household debt in the United States, behind mortgage debt. Last year, student loans had the highest delinquency rate of any form of household credit. And we read almost every day a story, like I've tried to illustrate here, a story of some former student who is suffering under an overwhelming burden of outlandish student loan debt. The dentist with $1 million of student loan debt, or some poor teacher who's a single parent who owes $77,000 and can't figure out how to achieve loan forgiveness under a government program. And so we clearly have too many student borrowers who regret their choices, who feel like they were fooled or misled, or who are otherwise burdened by their student loans. And that is a real problem. So one reason it's a problem is what I said earlier, is that there are big gains to going to college, and it can be a pathway to the middle class. The other reason it's a big problem is because financial aid and student loans play a central role in providing access to college to low and middle income students. So what this chart shows is average college attendance at age 22 by parent income rank. So what you can see is that almost all kids in high income families are in college at age 20, just after they finish high school. But less than half of lower income kids are enrolled at that age. And while there is some catch up in attendance after age 22, by and large, many fewer low-income students end up going to college at all. Those that do go to college are highly reliant on financial aid. The vast majority of the low-income students in these samples, for instance, use Pell Grants or student loans. And so absent student loans, it's clear that many fewer low and middle-income students would be able to go to college at all. And indeed, that well-intentioned desire to increase access to college largely explains how we got into this mess. So over time, the federal government has dramatically expanded access to federal loans. We expanded the number of institutions eligible to participate in the loan program in the early 80s. We made parents as well as students eligible for loans. In the early 90s, we expanded access to loans to borrowers from higher income families who could not demonstrate financial need. We eliminated limitations on the amounts that parents could borrow, allowing them to borrow up to the cost of attendance. We raised borrowing limits for undergraduates and graduate students. Again, in the 2000s, we increased borrowing limits for graduate students and undergraduates. We allowed graduate students to borrow up to the cost of attendance. And at the same time, we were increasing the dollar amounts that students could borrow. We were also expanding the types of programs that qualified for federal aid. We allowed certain for-profit schools and online programs to qualify for aid, even those had been previously excluded as being too risky. And by and large, as more students became eligible for more aid, institutions responded in turn by offering new types of programs. They increased the tuition they charged, and they expanded rapidly in size, enrolling more and more students who are reliant on federal loans. And so as a result, students across the board borrowed in vastly larger numbers and amounts. To illustrate this, here's just the data in 2001. And what this shows is that the average student loan balance, it shows the average student loan balance within each segment of the population divided by income percentile. So the way you would read this is to say the average household in the top 10% of the income distribution owed just under $4,000 in student debt. Now, obviously, most households did not owe student debt, and those that did owed more than $4,000. But what you can see is, first of all, that almost no low-income household owed any debt at all. In practice, there was only about 4% of low-income households that had any student loan debt. When they had debt, they only owed about $6,000. The largest balances are owed by high-income households, so about 10% of the highest income, 10% of households in the highest income group had any student loan debt. The average debt conditional on having debt was about $35,000. And in practice at that time, that worked out fine because people were borrowing amounts that they could repay. The borrowers that had a lot of debt were higher income households. But that changed very quickly over the last 20 years. So here is the year 2016. First of all, you can see that there are big increases in indebtedness across the board. So a rough rule of thumb is that there are twice as many households who owe student loan debt, and the average amount each of them owes has also doubled. The largest absolute amount is among the upper middle class, so not the top 10%, but the next 10%. But the largest percentage increase is among the lowest income households, who had rarely owed debt in the past and now are more likely to owe and owe large dollar amounts. Partly, I think people recognize that this is due to increases in tuition, but tuition increases actually are only a small part of the story here and can't explain much of the overall increase in student debt. Instead, one reason is that many more lower income people have borrowed to attend some college, not necessarily a high quality college, and not necessarily, they didn't necessarily attend enough to get a degree. More middle and upper middle class households have borrowed to attend graduate programs, and at those programs they now accumulate very large balances. And to some extent, today's students get less help from parents and pay less out of pocket. Partly this was the recession, but partly it seems to be a trend, perhaps, that people are just throwing up their hands and saying it costs too much, so I'm not even going to bother. And so I guess the one thing to emphasize in this chart is that despite these increases in debt, by and large, if you look at the average borrower, the average amount that they borrow is still modest relative to the average return to the average college degree. But clearly for many borrowers who have low incomes, or for borrowers who have modest incomes or even good incomes, but who have very large debts, these loans can be overwhelming. Well, so why are borrowers overwhelmed? I think the short answer is that we make loans to people that we know can't be repaid, and we encourage students to take them. I'm going to go and show you a couple slides that illustrate exactly what I mean by that, starting with this one. This ranks schools based on the repayment rate of its borrowers. So it says how much they've repaid on their loans after 5 years. And it classifies them into 10 buckets. So from the schools with the lowest repayment rates to the schools with the highest repayment rates. For perspective, if people are in the standard 10-year repayment plan, then after 5 years, borrowers should have repaid about 40 to 45% of their loan balance. You can see from this chart that only at the top 10% of institutions is that the norm. At many institutions, the average borrower has made little progress repaying their loans. At these low repayment rate institutions, many borrowers are delinquent or in default or have their payments suspended because of financial hardship. It pains me to say this, but when we make loans to students and parents at these institutions, we know they're going to struggle to repay those loans. We know they're going to default in high numbers, and we know the loans are going to be a drag on them. In many cases, this is because we make loans for students to attend low-quality institutions. As one illustration, this chart shows the average earnings of individuals who have graduated with a very specific certificate in radiologic technology. So this is a credential that's intended to help them get a very specific job in healthcare. What you can see is that graduates of the top program in this field earn more than 4 times as much as graduates in the worst program. First of all, we don't really make this information available to consumers who are seeking out this. That's starting to change, which is a good thing. Second of all, we offer the same amount of financial aid to the worst program as the best one. And indeed, because the lowest performing institutions, at least in this chart, are generally proprietary for-profit institutions, those students often end up borrowing more, even if they earn less. And so, of course, students who attend those low-performing schools are going to struggle. And programs like these are an important reason why the number of low-income households struggle so much with their debt. Similarly, many graduate students and parents struggle to repay their loans because we lend them very large amounts that we know often exceed their ability to repay. I can give you many examples, but to pick on USC, they charge $107,000 for a master's degree in social work, a field where the median person earns $47,000. So there's no way for somebody who earns $47,000 to repay a $107,000 student loan. And yet the government lends that person can lend that person the entire $107,000, even when there's an equivalent program at UCLA that costs $33,000 and the equivalent program at Cal State LA is $7,000. For parents, it's often worse. Just for example, 10% of parents who make less than $20,000 a year take up parent loans to send their kid to college. In 2014, the average parent loan was $15,000 for that year alone. We know those parents are going to default, and there's no loan forgiveness or income-based repayment for parents. So what that means is we garnish their wages and their Social Security, and we take away their tax refund. And so it's no wonder that borrowers feel their student loans can be a catastrophe. And so after highlighting some of those problems, I wanted to offer some more reasons to be optimistic. So the first thing to say is that most undergraduates actually borrow reasonable amounts, and they use the loan program responsibly and finance good educational investments. As a result, most undergraduates accumulate little to no debt by the time they graduate. Among those graduating in 2012, for instance, 30% had not borrowed at all, and 70% had borrowed less than $30,000. If you attended a 4-year public or private institution rather than a for-profit school, you're even more likely to graduate without debt or with modest amounts of debt, and your economic outcomes are often better. And so yes, while undergraduate debt is going up, partly that's because more students are going to college. They might not be going to the right college, but I think that's something we can fix. And there are clearly many colleges in the U.S. that lead to good jobs and allow them to graduate with modest amounts of debt, and we need to send more students to those types of schools. In addition, it's important to recognize that we've implemented a lot of very good income-based repayment plans, which are intended to limit the amount that borrowers have to repay each month based on their annual income. So we cap those payments at 10% of their discretionary income, and we forgive those balances after a period of time. And so this chart just shows the impact of that program. It shows the average monthly payment of student loan borrowers by income group in 2001 and 2016. What you can see is that despite the big increase in the amount of debt owed, monthly payments among borrowers with student loans have actually gone down almost across the board. So there's more borrowers today, and they certainly owe more in the past, but those borrowers are paying a smaller fraction of their income in loan payments today than borrowers in 2001. And so to conclude, I mean, it is an important system, an important way that we provide access to college for low and middle income students. It is a system that is worth saving. There are many good opportunities to go to college and to get a good degree. I think with better advice to students, restoration of accountability systems that steered federal funds away from low quality or low performing institutions, limitations on excessive borrowing, I am optimistic we can get back on track. Thank you.
Thanks, Adam. So I think I'm going to start by just saying a little bit. About 2 years ago, when the financial security program was picking a second topic for our EPIC process, we chose consumer debt. So we basically all forms of debt besides mortgage debt, and that deep dive process is, understanding the dimensions and drivers of the problem. When it's a challenge, we think access to credit is such an important part of building wealth, but the sense of actually calling out debt. And part of the reason that we decided to go there was because while there are so many deep understandings of different facets of both credit and debt, looking at the debt stack from the point of view of the consumer and how that has changed over time, what felt like an important additional dimension. So each of you have really kind of painted a picture of a specific piece of the knowledge around what is changing historically and more recently around a consumer's debt stack. And I think, for us, we came away with one clear mantra at the end, which is that consumer debt is systemic, consequential, and solvable. So I actually want to start there to have each of you jump in a little bit with the dimensions of your research that show up the systemic and consequential piece, and we'll move into the solvable in a minute. But I think maybe Marissa, start with you, and then if you want to comment on somebody else's perspective on it too, I think let's hope that this is more of a conversation than a hub and spoke back to me. So.
Yeah. So. I would say, starting with the New Deal onward, you had a sense of, 40 or so years, from 1934 until 1970 of this social contract, call it what you will, where the debt, the credit was federally guaranteed. There was heavy state regulation, and granted, some of that was overkill, especially on, mortgage lending and interest rate caps and all of this stuff. There was just a lot of regulations on debt, but also a lot of federal guarantees. And so there was this sense in which the government was taking on the risk. And then in the 1970s, you have this revision of this, call it the social contract, and we'll call it like neoliberalism, let's say, right? And the risk shifts onto the individual. So you make the right decisions, you take on the debt, you can, take care of yourself. So this comes through the student lending, through, the credit markets, but also through, 401ks, right? We go from pensions to sort of you create your own sort of retirement package. You do that through mortgages, you do it through student loans, and so the shift of the risk comes onto the individual, and then the structure shifts as well, right? And then there's a lot of other stuff going on in the secondary market. So not only do we shift that debt risk onto individuals, but we also take the regulation away, right? So at that same time, the usury cap lifts, essentially, right? Through the Marquette decision, now we've got a race to the bottom of usury caps through payday, and some of those maps showed the states that have the highest payday are the ones without caps, right? And then you can go into that state and then lend nationwide. And you have the same with banking regulations. So then you've got the subprime market and all of this other stuff. So, that dual shift creates this unsustainable, I think, market where you've got a deregulated financial system that is, incentivized to find those vulnerable sort of pain points, and you have people themselves, individuals, bearing the risk of their own debt.
Can I probe with one thing that you ended, and it wasn't really the end of your presentation, it was the end of your time for your presentation, so we're clear about those pieces of it. You ended with a pretty, I wouldn't say provocative statement. It felt like for you the data was there that it wasn't, that entrepreneurship and access to credit for entrepreneurship for African American, I just want you to unpack what you said about that, especially given how much of the research the Fed has come up with saying that actually entrepreneurship is a pretty important wealth creation strategy for an African American middle class piece.
The data I've seen, 98% of entrepreneurs are single man shops. Small businesses are not lucrative. And when we talk about entrepreneurs, the vision we have is Jeff Bezos and Mark Zuckerberg. But entrepreneurs typically, these are one people shop. The credit is not there for small entrepreneurs, especially African American ones. And the idea here is that, Yes, the reason why I contrasted the federal creation, the intergenerational white wealth in those white neighborhoods were created through that home mortgage and that GI Bill. I'm not talking about the top 5% or the bottom. I'm talking about the middle class. That was created through mortgage and student loans. And when the sort of post-civil rights committee, the sort of black communities say, okay, cut us in, then it shifts to entrepreneurship.
So, okay.
So it's that contrast that I think.
Well, maybe
fine, yes, entrepreneurship for everybody, yes, home mortgages for everybody, but not one and the other. That
No,
seems
that's helpful, and I'm sure we'll come back into it. And Cindy, I'm not skipping you, but given that you just posited another important statement, which is middle class was built on mortgages and education. And Adam, I'd like to go to you next in terms of the systemic changes you've seen in terms of the role of credit and education and how that plays into this changing nature of who gets to be middle class in America.
Sure. Well, I mean, I think in the biggest picture, education has and it can continue to be an important pathway to the middle class. And it's very clear that the more education you have on average, the better you do. I think over the last 15 or 20 years, we've had this revolution in how education is financed that has not always been a good thing. And so in particular, at the margins of among what I call the non-traditional educational institutions, we've seen big increases in debt but not necessarily big increases in educational attainment or completion of degrees. And so to be concrete, I think if you look over the last several years at students who went to the University of Michigan and completed four-year degrees, or any public four-year institution in the country, really, those students graduate with modest amounts of debt. By and large, they enter into the middle class. They're rarely unemployed. They earn high incomes, and they rarely default on their loans. And I think that core of the program is an extremely valuable and productive way that we finance education and allow people to move up the income ladder. And moreover, it's broadly self-financing in the sense that those graduates then repay the loan program, which means that it's not vulnerable as other social insurance programs are to being eroded by somebody paying for somebody else's program. But at the margins of that program, we now have online programs that probably don't offer very much value. We have a lot of less than BA degree credentials that sometimes, but not always, offer value. And when they don't offer value, the student still has to repay the loan. We don't do a good job of sorting out at the federal level, or I think even at the institution level, people who want to provide a good education. We don't do necessarily a good job of identifying which programs are being successful. And so that ends up, and then among graduate students and parents, as I said, I think there's a lot of people who now just take out extremely large sums of money that are just unbelievable and irrational in some ways. And so in those circumstances, people really do get into trouble, and that's not they've not benefited from that educational experience. It's made them worse off, and I think that is a big problem.
And the risk, I mean, it feels twofold, maybe to this systemic piece that we're on for a minute, this kind of systemic consequences. So for the households, right, the downstream issues of displacing other kinds of household formation and major purchases, like the debt. So the debt stack is not just changing, it's growing for any particular household, right? A debt to income ratio, as you were pointing out on some of those things. Is there a correlate issue of systemic risk in the economy from the way that the education debt piece of the stack is playing out?
Well, I mean, so I think that it's true that student loans,
A little closer to your...
student loans are being a drag. I mean, it's not clear exactly how big a systematic drag it is, but for instance, the Fed economists have estimated that the increase in student loan debt over the last 15 years or so has dragged down the home ownership rate among young households by a significant amount. It doesn't explain most, or even, I think it only explains perhaps 20% of the reduction in home ownership, but it's a real drag on those households. And so I do think it is a problem.
I think of questions for each other as well, but Cindy, I actually wanted to come to you last because it almost feels like in some ways I mean, is the population that you've been studying in the payday loan work, I do think this debt stack is true across the board. People that MRSA is looking at in your data and in your history, people that Adam's looking at, are they the same people getting payday loans? And what is the cumulative impact of what you're seeing when you put it in combination with these other places where credit, which used to be kind of the way you got a path to the middle class, is now potentially creating a lot of the blockages from getting there or staying there?
Well, I think the population I focus on is very low income. So when we think about trying to move low income into the middle class, probably some of those borrowers are more, not able to get the student loans. Some of the children that we saw in the Moving to Opportunity experiment, those that have better credit outcomes, they are able to access traditional student loans and are more likely to go to college. The adults and the children who were not able to benefit are sort of hit this sort of wall of credit, and their alternative is just subprime credit. And while many of the caps in certain states have been very successful in eliminating some of these high interest, high risk products, there's still, what is the alternative? How do you access cable? How do you access internet? When we doing these projects, we talked to a number of housing authorities, and a large challenge that they were facing is they wanted to move families to better neighborhoods because they know the benefits for future generations as well, but being able to sustain economic self-sufficiency or even getting these families the credit they need to, so even if you have a Section 8 housing voucher, you still have to qualify credit-wise to a landlord to be able to live in those better zip codes. And so that remains a barrier, being able to access the education, being able to move past. And so it's very subprime credit market. And some of the work I didn't talk about that I also work on is on financial literacy. And so what might be going on in some of these neighborhoods is just having access to basic education that prepares you to be able to take out the credit and understand how much credit that is risky or not risky to take out overall.
Yeah, I mean, I think that can confound the systemic piece of this for people.
Right.
Is, in some ways it strikes me that everybody you're talking about is in some ways making the same fundamental choices to better their lives or solve the problems of their life that they have always made. The types of access, the types of systems of debt that they get involved with actually end up potentially having a dampening effect versus, but I wonder though, I think that then there's this risk we have sometimes of putting, it being about the poor choices of individuals. So I think that there's a raging debate right now about financial literacy versus structures and systems, and I mean, for me, that would be another place to grapple for each of you a little bit with, what do you say to that issue of individual choices that are trying to drive this in some ways, or is it really still mainly the structure and the legal parameters of this and that are really driving the fundamentally different balance sheets we're seeing for households today?
I'm a skeptic of financial literacy. I mean, I think the data, there's a meta study just recently that it just doesn't work. I mean, it depends on what are you looking at, right? If we're talking about, if you're going to a for-profit college, them telling you, like exactly what he said, this is the percentage of people that pay back this loan. That is important financial literacy to say, this is not a good thing to do,
Just
right?
in time information.
However,
yeah.
I mean, I think one of the other sort of impacts of this, new era is this just disclosure will fix it. Even if it's a bad loan, if you just disclose it and you see, I mean, there's all of this data where you give someone a mortgage with all of the, mortgage disclosures, they're not looking at it. And sure, that's everyone's fault, but are you looking when you click on your, clip wrap? I teach contracts and I do these things every year in contracts where I, have them sell me their soul in the beginning of, and they all sign it and we all just do that, right? And this is we've got forced arbitration clauses, we've got, there's no way to fight these provisions. And so, and the other thing with financial literacy is that actually people who borrow from payday lending and have these debts that they service actually are quite aware of the costs. And there is research. I mean, great research. They intercepted people coming out of a grocery store, low-income people versus high-income people, and they asked them, how much is in your cart? How much did you just spend? And then pick out an item. How much was that item? And if you were to ask me that, I just wouldn't know. But the poor always know. They know where the pennies are going because you have to, because your life can depend on it, your foreclosure, your rent. So I think it's financial literacy.
No, it's good. No, and I didn't mean to set it up as an either or, but I'll bring you in, Adam, and then I can think of a question for each other on this, and then we will go. Is the 5 minutes to go to Q&A, or is the 5 minutes including Q&A? Okay. Good. So I'm just, because you ended up with a lot about ability to repay, which can also translate into, fundamentally driving policy on people's decision-making ability or not, or there's a different way to address those problems. So I just wonder how you want to weigh in on this issue.
Sure. Well, I mean, I think there's an element of financial disclosure and making the borrowers aware of these problems. And so I too am skeptical of financial literacy as a real driver of change in this area. I do think that disclosure and producing information on these outcomes is very important. Some consumers do use that information, but there's a lot of other people who are stakeholders in the educational system. There are parents and their family members. There are also college presidents who care about whether I'm offering the right types of programs for my community, which of the programs I offer are successfully leading people into jobs. Is the tuition I'm imposing on students in this program too high for them to repay? So I think that there is some financial literacy in education that can apply to a wide variety of groups and be useful. I think that's probably true of policymakers too. I don't think anybody has known until very recently how many students are able to repay their loans at different institutions or how much people earn after college. And so that's relatively new information, and I think it's driving people in Congress and in states to make changes. So I think that is important.
Comments on each other's presentations, and then we'll move into the Q&A in a minute, and I want to get a little bit into solutions as well, but curious if you just have some observations of each other's work
So
before
I
we
was
go
just
there.
going to mention, Ida, when you talk about poor choices, whether it's poor choices or alternatives, when that distribution I showed you of payday loan borrowers, I mentioned almost 80%, they're very credit constrained. We do see a significant minority of those payday loan borrowers who still have a significant amount of credit available, and there have been other studies on payday loans in other countries that suggest they're using these payday loans for what we call maybe temptation borrowing, suggesting there's some sort of poor choice going on there. But for the vast majority of the payday loan borrowers we look at least in the US, are clearly going to these alternatives because they have some sort of
limited
credit
choice.
need.
Yeah.
Limited choice. So.
Yeah.
I wonder what your thoughts are on for-profit colleges. I mean, there's the recent bills on just, is there a sector of educational institutions that should not exist, or that we need to regulate? I mean, the answer would be just not disclosure, but just shut them down.
Sure. Well, so I think that people are very specifically concerned about for-profit schools. I mean, I think that there's a philosophical issue that I grapple with, which is that I buy all of my goods and services from for-profit providers, and by and large, that works really well for me. And so when you go to the education sector, there's a question of why is it so terrible in that sector? Because the reality is that the outcomes are much worse for people who attend for-profit schools. They end up with much more debt. If you look at the earnings of the students before and after they attend, it doesn't seem like there was any value added in the sense of their earnings going up from having attended those programs. So I am skeptical of that sector. On the other hand, I think we should be more broadly skeptical about similar programs that operate in the public and private nonprofit sector. So there are low-performing programs at a wider variety of institutions. it's not just about being fair. I think it's about if we care about protecting students from debts that can't be repaid and protecting taxpayers from having to bear the losses of people who can't repay those loans. We should look at students who can't repay their loans at all types of schools. I think even more clearly, there are some programs now at public and private nonprofit schools that look like for-profit schools. Big online programs that are enormous money makers at Southern New Hampshire University or at Liberty or at Arizona State or at Purdue that are basically for-profit schools in everything other than the name, Grand Canyon University. So in that sense, I don't think that, I think that there are problems concentrated in the for-profit sector, but I also think that there are problems elsewhere that we should address.
More systematic than that. So we're going to switch now to microphones, and we are happy to start taking questions. Please identify yourself as you ask a question.
Hi, Ida. I'm Connie Evans with
Hi,
the
Connie.
Association for Enterprise Opportunity. I don't think I have a question. I was quite confused with the statement on Black entrepreneurship, and I would hate for this room to leave with not a clear understanding, because entrepreneurship really is key to driving wealth in the Black community. At a study that AEO produced called The Tapestry of Black Business Ownership in America, our research found that while white adults have 13 times the wealth that Black adults do, when we compare median wealth of Black and white business owners, the median wealth gap decreases to a multiplier of 3. That's key in closing the racial wealth gap. And so again, Black business and Black entrepreneurship is key, and it is clearly an issue in terms of capital access and Blacks not having access to the right size capital they need, not only to start, but to really grow their business. And so again, I wasn't sure what was said, but I just wanted to be clear that there is a big difference in terms of how Blacks are able to create wealth through business ownership. Thank you.
I'm really glad, Connie, that you're in the room and asked, because I didn't plan to leave it where we had gotten to with the last question either. I think you should jump in with the first, trying to clarify that. I said it because I wanted you to clarify what you said up there, but I do think it's worthwhile to bring that in.
I 100% agree about the capital, the access to capital, and I think it's like a chicken and egg problem. I think you need capital to have a thriving business, and without a thriving business, you can't have capital. So, you really do need a lot more capital.
I think it sounded to me, and maybe this is wrong, you were saying you don't need more.
talking about the Black entrepreneurs. I was talking about the subprime lenders.
The structural dimensions of credit haven't changed in ways that facilitate more access to the kind of credit that would make entrepreneurship an even more viable. I maybe finish that sentence with a little bit more, because you were getting to a structural dimension of the problem.
My specific comment was on the programs that were started in the Clinton era, and it wasn't just Black entrepreneurs. It was to sort of lower the barriers for credit in these communities, and they didn't define credit. And so what you have is subprime credit. You have wealth extracting credit. So it's like defining an education. You could do a for-profit school or nonprofit. So there are all of these things. I think if you're talking about entrepreneurship, there's wealth building entrepreneurship with capital, and there's non-wealth building entrepreneurship. Not all entrepreneurship is created equal. Not all credit is created equal.
Not all educational credit is created equal. Connie, where are you? Is that a helpful clarification for the moment? We're going to talk it through later? Okay, great. Next question? Hi, yeah. Oh, I'm sorry, I missed you, ma'am. Go ahead.
Me? Okay. Hi, I'm Pam Queen. I'm a state legislator. And so as a policy thing, we spend a lot of money on education as a way of financial stability and upward mobility. And I think one of the things that Adam kind of alluded to is that you can go to one school, pay less than $20,000 for tuition, and get a job at making maybe $45,000 a year, and then go to another school and pay almost $40,000 in tuition and still get that same job making $45,000 a year. And so we've been grappling with how do you measure sort of a return on investment for us to kind of say, is this worthwhile for us to, put state funds to? So my thought with student loans is there some measure of return on investment that maybe we could suggest that is indicated so families can know, why are you paying all this money for a degree and taking all these loans and you're never going to get a good return on investment in terms of the salary that person can garner?
Sure. So I think this is an enormously important issue because I think we kind of treat college like wine, where we think if the price is higher, it must be better, and I don't think that's true. There are many public institutions at the state-funded institutions that are extremely good and just as good as higher-priced institutions. And within those institutions, there are often programs that cost exactly the same. Often tuition is the same at the institution for one BA or one credential versus another. But the outcomes of those students in the labor market are quite different. And so I think it's an important thing to pursue, and I think that there is a lot of value that you can unlock and a lot of kind of pain and suffering from loan repayment that you could reduce if you could direct students to better programs. It is also a hard problem, in part because we don't know that much about outcomes, but we're starting to. So, for instance, the college scorecard now comes out on a regular basis that provides information on the post-college earnings of students. That's updated regularly, so you get a sense of what the typical labor market outcome of students are at different schools. On that scorecard, you also know how much debt students end with. You know something about the net tuition that students face. So you can get a sense of, if I'm choosing among several programs and they all turn out to have the same post-college earnings, then maybe I should go to the one where everybody leaves with only $12,000 of debt instead of the ones that leave with $36,000 of debt. And so I think that's that's what I would advise somebody who is choosing between, like a friend choosing between programs. I think that at the state level or at the federal level, we should do sort of the same thing, try to prioritize programs that have high post-college outcomes and that cost less. So
are you saying you don't need to get all the way to an ROI formula, you're just looking at returns to education and just a...
Yeah, I think in some ways it's a lot simpler. I actually think that if you look at the literature, the most sophisticated literature on education, you arrive at a rule of thumb, which is that if you take somebody and you assign them to a college, they tend to have like exactly the same outcome on average as the average student at that school. They complete at the same rate, they get a job at the same rate, they incur debt at the same rate, by and large. And so I think that those kind of averages are good rules of thumb to use.
Thanks. I'm not sure. You were standing, then you're sitting, and now you're standing. So come on up.
Do you want to go first? Okay, all right. I don't know if I can adjust this, but can you all hear me?
Yeah.
And so I'm Zoe Mani. I'm a PhD student in public administration at Virginia Tech. I'm a graduate student intern at the Board of Governors of the Federal Reserve System. And currently, I'm the graduate student representative to the Board of Visitors at Virginia Tech. One of the major issues affecting college campuses, including ours, is student mental health. We completed a mental health task report, and a lot of students reported that a lot of stress is coming from finances. So in all these conversations about student loans, it's like, how do we focus on the students and their psyche? Because, so essentially my two questions are, just for the conversation, is what does this data imply about mental health in regard to increasing levels of stress due to finance for students who take out these loans, in addition to working adults? And then how can we motivate young adults to invest in themselves while knowing the challenges of loan repayment in addition to competing in a global labor market?
small questions. Do we have a reception after this? Because I'm going to need a drink. But it's just a question.
So I agree this is a big issue, and I think the financial component of college is overwhelmingly important. I mean, so I think in Virginia and in states around the country, I worry that states have disinvested from education, which has meant that students and their families have to come up with a larger share of the tuition bill.
Let me bring MRSA into that with you, because I think it goes a little bit to the risk shift you were talking about. So I just wanted to, is it a similar kind of, when you're saying that the changing policy structure in Virginia, where I live, so happy to, is shifting, this is a bit of a risk shift that's creating ripple effects in terms of.
Yeah, well, I don't want to speak specifically about Virginia because I'm not sure exactly
Right.
how they have changed, but I think by and large, states have, over the last couple of years, they've been crunched with budgets and they've contributed less. I think that's made it hard. I think that obviously we often encourage families to take out more loans to finance their education. And so I think that is a stressor.
There's certainly a lot of connections between, I know we wrote a lot about this in the EPIC process, just the connections between financial stress and mental health becoming more and more clear, everything from minimum wage research to student debt to just, again, this debt stack and what that's doing to drive workforce performance, student performance, and broader physical and mental health issues.
There's a lot of great behavioral economics research and mental sort of psychological research on scarcity. And I mean, really, when you're in a debt, when you have debt, your level of IQ goes down. Like really, really smart people taking tests in a scarcity mindset versus not, you're not able to function as well, because you have such a stress that is, a mental load. I mean, same with hunger or time or whatever in that scarcity mindset. So there's really great research. I mean, there's this book called Scarcity, but there's a lot of sort of psychological work being done now just to understand that. And this is why I think financial literacy is difficult, because you really have to take into account that whole sort of survival nature, right? If you're going to get kicked out of your home, you're going to do whatever it takes to not lose shelter, And so what is rational in that situation? It is perfectly rational to go get a payday loan, right? Or a student loan. If your only option is a for-profit college and you've got, you're a single mom, and a lot of single moms end up doing this, what is rational at that point? So I think it is tough, and I see it with my students as well. And that's one of the reasons I'm at the University of Georgia. Not to put a plug, but public law schools specifically give students a huge debt burden. And states like ours, luckily, I go to a law school I teach at a law school that is very heavily subsidized. So you can graduate at the University of Georgia and several other state schools with really, really low debt. Our undergrads have full-on state scholarships through the Hope Scholarship, which is regressive, but still. So most of our students go out and are able to have this. And I think that's really important for those of us who work at that higher sort of administration level to be careful about the institutions that we end up bolstering.
And I want to make sure whatever question you're going to ask, make sure we ask it to Cindy. You can deflect it, Cindy, but I'm going to make sure that you're talking. Okay. And I think the other thing to just call out is, you said you're in public policy, public administration? Great. So I just want to give a shout out to the Federal Reserve System for the diversity of academic disciplines that we try to crowdsource onto a stage to talk about this issue. Incredibly important. Another one, as you're bringing up, is psychology, sociology, public health in general, and medicine, increasingly becoming part of this conversation. And so another place for the Federal Reserve to look and collaborate in time to come.
Hi, so my name's Catherine Brown. I'm at the Federal Reserve Bank of Chicago. And I have two questions about access to finance. So the first one is about alternative data. So banks are thinking about, how do you lend to someone that doesn't have sort of this really strong credit history? And so they've been talking about using, utility bill history, cell phone payments, rent payments, in order to determine a borrower's credit worthiness. And so I want to know your thoughts on that, if you think that's an effective tool, or do you think it's more or less just going to be, it's just more or less you're still going to have sort of discriminatory practices? And then my second question is about small dollar short-term lending. So last year in May, the OCC recently issued guidance on short-term small dollar lending in order to encourage it, because there was this idea that banks were hesitant to do so. So I want to know if you think that that's an effective tool to maybe get at borrowers turning to banks that are more regulated versus payday lenders that are less regulated.
See, it was a question for Cindy. Hooray.
Absolutely. To your first question, so I absolutely agree that I think the payday loan, what it really points to is this need for cash. Sometimes if we're not engaged in payday loans, it can be kind of incredulous. Why would you take out such a short loan with such a high rate? And the reason is the need for cash today. Even if it's from Monday to Friday, there's such a large need. We are seeing some encouragement of banks to try and lend to more subprime risky, but the problem is, as you highlighted, is that there isn't a lot of credit history. And something I pointed out was that all of the activity on the subprime market is not tracked on your standard credit report. And so then it becomes very difficult for someone who has a very thin credit file to move past that barrier. And some of the proposals have been, and as we were working on these projects, in that process, there's been a number of lobbies through housing authorities to encourage credit bureaus. We have 3 standard credit bureaus, Experian, Equifax, and TransUnion, to start including other good credit behaviors such as rental payments, utility payments, and some of these. So Experian, for example, purchased Clarity, which is underwriter of subprime borrowing. So they are now in-house themselves starting to try and track some of that activity, and some of the credit bureaus have started to come up with rental indicators. They're still not officially incorporated into your credit report, so it's not going to impact your credit score, but we are starting to see some of movement towards that, and I think that is absolutely an avenue. Now, whether there will still be discriminatory practices out of that, I think that's something we have to keep in mind and look for regulation. Some of the research that we're doing now is looking for something that was highlighted out of the financial crisis, is that whether there were targeting of subprime. There's a lot of implications of targeting of subprime neighborhoods through that. So because we know it's very neighborhood based, some of that is very difficult to avoid. So I think some of the proposals that you're seeing are very encouraging and has the potential to improve and overcome these credit barriers, but it's still yet to be seen, I think.
Did you want to add to that?
No, just to say that payday lenders do no underwriting. They don't even look at the FICO score, so you just go in and everyone pays the same rate. So any underwriting in that low-cost credit market, low small dollar loan market would be a benefit to certain sort of non-prime but low sort of small dollar customers. And whether banks should do it, yes. I mean, in my first book, it was about small dollar credit, and I suggested postal banking, and that's gaining traction. And if you're not convinced, I think you can read more about it. But here, you have a bank that was, the post office was a bank, and the idea would be that they would give small loans just without, underwriting.
And I would follow up with some of these proposals are more feasible now than they used to be because of technology. So all of the data I showed you is actually just from 2013 to 2017, because a lot of the payday lenders have moved online. And so now they're able to do a lot of the electronic underwriting that they weren't able to do before, and follow the repayment behavior in a much more meticulous way. And so that's becoming more and more available, which is making it possible.
Yeah. And I don't see anybody else standing up. Any other? Yes, please. Final question.
I'm Maud Toussaint from the Federal Reserve Bank of Chicago. We've spoken a lot about quality of schools, even to some extent some that, predatory. I don't have a sense, but perhaps it's my own lack of knowledge, but I don't have a sense of what we are defining as bad school, in a sense of, especially when we are talking about perhaps there is some selection into some of the schools that are not at the high top tier type of schools, because one speaker this morning spoke about the differential return to education, you know, for example, for minorities. And so a lot of those sort of lesser quality schools, some student that goes in them, that's the choice basket that they have. And so are we doing justice in terms of understanding how to measure outcome from students coming out of different schools and associating, let's say, lack of income, wage similarity coming from those schools with different student makeup? It's just all very confusing to me how we're measuring those things and we're speaking about school and quality in a responsible way.
I want to thank you for your question. I want to suggest that we might actually take most of the answer offline because we're about to wrap this piece. And I think it's this combination of this morning's panel and this panel that would really speak to that. I think we could have changed the name of this in some way to Financing the American Dream. I think that's where a lot of the conversation went this afternoon. I think that's going to be layered onto yet again with tomorrow morning's plenary and sessions. And so I encourage you to continue to think about these issues as they hook together. And I also want to encourage you to thank our panel, Marissa, Cindy, and Adam, for this afternoon.